Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Oana.
Okay, so today we're going to talk about an article that just came out in Realtor.com because mortgage rates have dropped again for the fourth straight week in a row. Okay?
Okay.
So the article is mortgage rates just dropped again. Is it enough to save the spring housing market?
Okay, so I want to say something.
Okay.
So let's say that you're on a diet and you have been losing weight for 4 straight weeks in a row.
Okay.
And is it enough to fit in that bikini? Like, you know what? You're so much better off than you were 4 weeks ago. And it's the same thing with this. We're better off than we were 4 weeks ago. You know, we can squeeze into that house a little bit easier than we could 4 weeks ago.
Yeah, and it's we're going to go through all the data in here, but it's pretty clear that we're through the worst of this from an interest rate standpoint.
Mm-hmm.
Interest rates peaked almost 6 months ago now, and they've been down since then about a little over 1% from the peak. All the things you were told would happen when interest rates went up didn't really happen. 3 to 8%, depending on whether you just count median price or you just count price per square foot. Okay. Prices didn't change that much. They adjusted like we said they would, and they're going up nationally, right? We just found that February to March home prices went up.
Okay. And remember, we're up, what, 2.5% really from about a year ago?
We're going to talk about that.
Okay.
It's in here.
But what I was going to say is, remember the Crash Bros said that if interest rates go up that high, people are going to be forced to sell. How'd that work out?
Yeah.
Did you see it in the inventory?
It's pretty bad. Okay, so let's go through this. For the week ending April 6th, the interest rate for a 30-year fixed rate home loan averaged 6.28%, according to Freddie Mac, although that's much higher than a year ago when rates were at 4.72%. So it's 1.5%.
Okay.
It's a 1.5% difference. It's still at least down a bit from the 20-year high they reached near the end of last year, which is actually, I think, in October, November.
That's when all the shadow inventory came out, right? And there were homes for sale all over the place, and the market crashed,
No, they were getting ready to hit. The foreclosures, the banks were preparing to foreclose.
Okay.
I don't know on who, but they were going to foreclose. Okay, let's talk about that first of all. There has not been a direct one-for-one relationship between interest rates and the home prices.
No.
You could almost argue there's an inverse relationship.
Well, yeah, because we have less inventory, which is actually working to really stabilize the market because we have more demand than we do supply. And for those of you that say, well, there aren't as many buyers, you're right, but there also aren't as many houses. And the buyers that are out there, sometimes they're hard to notice because the houses that they would purchase are not on the market. And so these buyers are not visibly in the marketplace.
Right. Though week-to-week rate changes can move up and down, the longer-term prospect on rates is for further improvement with a clear possibility of going under 6% by the year's end, adds Yun. He's the chief economist for NAR. So his prediction is rates under 6%.
Which they are under 6% now for well-qualified buyers.
FHA, they're under 6. VA, they're in the low 5s now for a VA loan. Portfolio purchasers probably in the low 5s if you're a portfolio client. Okay, if you have a really high credit score, they're probably below 6 or below. Yeah, they're below 6.
Absolutely, which is my point that for well-qualified buyers, they're going to be under 6.
Okay, yeah, and if people that have frantically said about the prices. The difference on a median price home with 20% down between 7.2 and 6.2% is about like $130 a month in your payment. It's not a huge payment. Okay, here's an interesting quote from the article. For one, listing prices for the week ending April 1st are still higher than last year, although barely so, growing by just 4.4%.
So what you're saying is that 4.4% is insufficient growth against, what, $500,000? Because that's what the house might be worth? I don't know. I'm thinking 4.4% against 500,000 is pretty decent growth.
If you would have told somebody last June, after all the negative news was coming out, that April to April list prices would be up 4.4%, you absolutely would have thought you were incredibly crazy to believe that would happen, right? But it happened. That's the reality. So, to pick a single metric and try to pin everything on one thing, the housing market is sort of like a human body. There's a lot of moving parts to it and pieces. So just because one isn't doing great doesn't mean others don't make up for it. Okay. Here's a quote that really got me. Still with listings hovering at a median asking price of $428,000, the final week of March and beginning of April still registered higher list prices than all but the priciest 5 months of 2022.
Right.
What do you think about that?
Well, again, so when you're comparing, whatever you're comparing to outliers, it's not a legitimate comparison. You can't compare everything to outliers.
There's no question that it's going to be a while because, so in Las Vegas, from February to March, demand increased 37% in a month. Okay. Now, the negative Nellies, people who hate housing or whatever, are going to point out, but Todd, but last year, let's talk peak to trough. But in June of last year, forget that. June of last year was in the past. Okay. Just like June of 2011 was in the past, just like World War II was in the past. Okay. These are all events that were in the past. So forget about them. Okay. The only past we really care about is what happened last month. And the only future we really care about is what's going to happen next month. We're in 5 years or 10 years because we're going to live in those times. We're not going to go back ever unless you get in a time machine and go back to last year. It's not going to happen. So forget about it. Don't really care what's going to happen. One thing that we do know is this, another quote from the article that was the little headline of this part was called The Incredible Shrinking Housing Market. Another downside for buyers is the week ending April 1st marked the 39th straight, this is nationally, 39 straight weeks where fewer homeowners listed their homes for sale. Okay, this started October 20th. October 20th. You would zero probability have been able to get somebody to make a bet in June, July, or August of last year that starting October 20th, the inventory nationally would drop every single week for 39 straight. And if you told them interest rates were still going to be above 6%. Because what would they have expected? They would have said, oh, but the foreclosures, all the people that bought in June of 2022 are already going to have to sell, right? And guess what? You know why they're not up? Why aren't the people upside down that bought in June of last year?
Because they put money down.
Oh, they put money down. So upside down doesn't mean the house is worth less than you paid. What does upside down mean?
Upside down means that the house is worth less than the debt on it.
Oh.
So let's say that you paid $1 million for a house, and let's say you put 20% down. That means that the debt on the house is $800,000.
Okay.
That means that the house would have to be worth less than $800,000 for you to be upside down in it, and that's assuming you have not made any principal payments.
Okay, hold on a minute though. Let's say I bought a house for $400,000 at peak of the market, and let's say it's worth $380 now, right? But I put $100,000 down, so I only owe $300 on it, right? Actually owe less on it because I've made mortgage payments for a year, right? Okay. So you're saying if it's worth $380 and I paid $400, but I only owe $300, then I'm not forced to sell. I don't have to sell it.
Well, you wouldn't be forced to sell even if it was worth $0, because that has nothing to do with it.
Okay.
Okay, and you're not upside down in it so long as what you owe on it is less than what you could sell it for on the open market.
But I paid $400, it's only worth $380,000. Don't I have to write a check for $20,000 and give that to somebody to make up for the $20,000 less than it's worth?
You have to write a check and send it to me.
Send it to us.
Yes.
If you're upside down, figure out how much that is and send us the check right now.
Yes.
Okay? We want it. Immediately.
Look, I need
cashiers, and not from Silicon Valley Bank. Okay? Don't even.
I need a wardrobe budget, people. Go ahead and send the check.
Yeah, I know. I literally wear like the exact same thing every video with like
They know
six
that.
different shirts.
They know that.
Okay. It's not as bad as it was in 2010, 11, because I came to work every day in like a single pair of pants and the same about 7 shirts. So what was nice was the radio show.
Yeah.
We used to do that on Saturday, Talk About Houses radio show. It started at like noon or 1, wasn't it? It was kind of right in the middle of the day. It was a live real estate talk radio in Las Vegas. It was on Saturday. Remember, we used to show up in like shorts and stuff. We would just show up in whatever because it was radio.
Did somebody tell us that we had a face for radio?
No. I remember we used to have guests. We'd call people and go, "Hey, we have a radio show. Why don't you be on our?" So we got to meet all these pretty cool people. Some of like one of the guys was the guy who developed all of Southern Highlands. Like he was one of the main guys who built Southern Highlands. So we'd call these, and they'd be, "Yeah, I want to be on the radio show." And we always forget to tell them, dress casual to a radio show. These guys would show up in like slacks and like a sport coat maybe and really nicely dressed. And we'd be in like, not really flip-flops, but sneakers and like a t-shirt. And they'd be like, "Hey," and they'd be like, "Oh, hey, I'm here to meet you." And we're just like, "Oh shit, I forgot to tell you, it's radio." So you don't need, no one's going to see you. You don't need to be really, "Oh, I thought you guys would be maybe dressed up or whatever." And that didn't happen.
Okay, let's move on.
Okay, here we go. Next quote from the article. I apologize for the size of the text here. It is expected that the time on market will continue to decrease this spring as we head towards the annual Best Time to Sell a Home in mid-April in Las Vegas. We have this event called Best Time to Sell a Home. They have it at Sunset Park. Everybody comes out, they roast hot dogs, they play softball. It's kind of a fun event. It happens in mid-April in Sunset Park. You should come out and join us. It's sponsored by Talk About Houses every year. It's a big event, very popular in Vegas. Best time to sell a home. Nevertheless, sellers will need to adjust their expectations and pricing to account for the current market. Okay, this is the most ridiculous quote ever. Nevertheless, sellers need to adjust their expectations and pricing to account for the current market conditions. How many of the last 5,000, starting this week, going back 5,000 weeks into the past, how many weeks of the 5,000 has that sentence been true?
Everyone.
Everyone. So every time you put your house on the market as a seller, you have to adjust your expectation and pricing to account for current market conditions. Now, you don't have to. You could, there's still overpriced house listings on the market. And they sit there and people put offers at market value and they don't get accepted. You've seen that, right? You've seen a bunch of that.
We've seen that, and it's happened to us when we've worked with clients.
Okay, really quick. Since you're sort of super high-end, luxury, high-end homes, you're seeing a different market there.
It is. It's really interesting. Like one of the things that we see is sellers who don't want to put their house on the market, but they want to sell it, which is like, what? How does that even work?
So we're talking multi-million-dollar pocket listings.
Yes.
Why do they do that?
There are a lot of reasons, but probably the most popular reasons are people are very very guarded, that they value their privacy more than they value anything else, but they're not selling these properties for less than market value. They are selling them for at or above market value. There's a lot of privacy involved. A lot of times these homes are being sold completely furnished, that you just bring your toothbrush.
The furniture all comes
right. Yeah. So it's really interesting, but it happens all the time.
I'm gonna give you the final word. Your prognostication for we already did the video where we showed the projection that home prices would be down like 1.3% this year total, December, but then they would go up the next 5 years, right? What do you see happening? Mild recession possibly in the second half of the year. Historically, in a recession, home prices still go up, right? Because interest rates start tanking going into the recession, and home prices, buyer demand picks up because the economy's trying to chug along there.
Right.
Usually, the home prices fall right before the recession.
Right.
Yeah. So what's your projection for the year? Like, what do you see happening?
Stable prices, lower interest rates, not dramatically, nothing impressive, but lower interest rates by late fall. And then, next year, I think people are just going to be much more adventurous, I think.
Next year?
Yes.
Okay.
Next year is an election year, so there's going to be a lot of talk. There's going to be a lot more volatility, I think, next year than this year because of the election. Because as we go through the election cycle, there's much more uncertainty, and uncertainty breeds volatility. So you're going to see a lot more volatility. So different markets will do different things. It'll be interesting to see, how that affects real estate, because I think the interest rates are going to I think that they'll be lower, but not that much lower. I think that there's going to be efforts to keep the economy going so that the economy doesn't interfere with the election, if you will.
Okay.
But I think even that is an interference in the election. But that's another video right there. But I just think that next year there's going to be a lot more volatility than there is this year. I think this year is just going to be really stable.
Okay.
I think next year will be more volatile.
Here's my prediction. Interest rates are lower.
Okay.
Half a point. So I think in the fall we're seeing high fives for median rates. I think inventory's going to be higher. It is every year. But I think there'll be more sales in September, October, November, and December of this year than there were last year.
I'll agree with that.
I also predict that the Crash Bros will still compare it to June of 2022. They will compare the June of 2022 sales to the fall.
Okay.
They will pick a spring month to compare to the fall. They won't compare. Once they see the fall over fall numbers that more sales, they won't talk about it. They'll be very quiet. Okay, I predict that. Home prices plus or minus 2 or 3%. I think they moderate, right? We just read the thing where the list prices were 5% it was up 4.4% year over year from last year, which was a super hot year.
Right.
So I think we see list prices higher next fall, this coming fall, than we did the previous fall. I think last fall they tanked a bit. So I think that home prices are rising now. I think they'll sort of go up a bit. Bottom line is here's the thing: if you own a house, who cares? If you have a rental, you don't care. You're just going to collect rent every month. I think rents do not drop. I do not see a wave of foreclosures. I do not see a bunch of new homes that the builders have been just waiting. Okay, guys, are you ready? Let's dump all the houses on the market. That they don't exist. They've all been sold or they're in the MLS. The new home builders, that we're through that already. It's already done. All the negative prognostication thing is all BS. But we do have sort of a little tumultuousness certainly in commercial real estate, office. You'll see negative headlines with real estate, but it'll be office buildings, and that maybe some more regional bank problems, but none of this will affect real estate. Mm-hmm. And then the stock market, who knows what's going to happen, but I see long-term people not giving up their real estate. I see long-term, if you had watched videos 5 or 6 years ago, all these knuckleheads were telling you, sell your house and put it all in the stock market. You can go back and find these videos. I'm not going to say their names. You know who they are. Sell your houses. They're only giving you a 4 or 5% return. The stock market gives you 12%. You should sell your house, rent, and put it all in the stock market. How is that working for you? Because you probably have lost a ton of money based on their stupid advice. So I think people are going to say, screw that. I don't know about banks. I don't know about the stock market, but I know I'm getting appreciation on my house. I'm getting rent on my house. People that have rental houses. That's my forecast. I'm not selling any rentals.
There you go. All right. So this video was all over the place. Sorry. Apparently we were...
It's late.
We were apparently...
It was a long week. It was a very long week.
Yeah. There's apparently some ADD going on around here.
Yeah.
So we apologize. If you made it to the end, kudos for you, because this was not one of our best. Sorry about that.
No, it was fun.
But it was.
I had fun.
We had fun. So please like the video, subscribe, hit the notification bell. If you're new to the channel, honestly, we're much more coherent normally.
Yeah.
Watch the other.
We haven't had anything to drink tonight either.
No. So watch the other videos, please, and you'll see we are much more coherent than we were tonight. So we apologize. Please like the videos, share, subscribe, hit the notification bell. leave us a note, and we will see you on the next video. Bye.
Bye.